Hey everybody, welcome to Chapter 3. Chapter 3 is where it starts getting a little confusing. I know Chapters 1 and 2 were probably already a little confusing, but Chapter 3 we get into the concept of debits and credits, and this throws people off sometimes. So pay attention and don't be afraid to ask for help. All right, so there's the learning objectives, 9 of them. You can read through all of them. There you go. If you really want to read them, pause it and read them. This breaks down how they're going to cover it: accounting information system, the account, steps in the recording process, and the trial balance. We'll probably spend the most time on accounts and steps in the recording process. Anyway, so that's Chapter 3 as a overview. All right, so I think we've already talked about that accounting is really just our means of communicating financial information to people. This says it's even more, it's collecting and processing the data and then communicating the data to the decision makers, which is all part of the process there. When we're doing our accounting, we're worried about transactions. Transactions are events that require recording. So not all things that a business does require reporting, so not all things are transactions. Our broad types of accounts, assets, liabilities, and equity, change as a result of some sort of event that's happened, and we'll always have what's called a dual effect. This is called dual entry accounting. This is what we do in the United States and most of Western Europe, and really I think it's becoming more and more accepted across the world, this means of doing accounting. By dual entry we mean two accounts are always impacted. If one account, say an asset, increases, then we're likely to have a corresponding increase in a liability account or an equity account, for example, and you'll see some examples of that coming up here. All right, so the first question is, do the following events constitute transactions, or in other words, should they be recorded in our accounting records? So the first event is the purchase of a computer. And then the criterion of the question we have to ask ourselves is the financial position of the company changed? If we purchase a computer, certainly, right, things change. Our assets increase. We have an asset computer that increases and an asset cash that decreases. So that would be a change, and it would be a recordable event. The second is we discuss guided trip options with potential customers. Again, same question. Does anything change? And the answer is no. Just discussing something with a customer doesn't change anything. And then finally, paying rent. Well, for sure, right? Our asset cash will go down and our rent expense will increase. So that's the idea of defining or deciding whether or not something is a transaction. All right. So we've already mentioned the basic accounting equation as assets equal liabilities plus our stockholders' equity. I call it the fundamental accounting equation, but that's probably just because I was taught it that way. Assets equal liabilities plus equity. Okay, so as we analyze transactions, we're going to recognize that how interrelated these things are. All right, they break down assets equal liabilities plus stockholders' equity. Then they further break down stockholders' equity into common stock. That's money that stockholders have put into the business, and retained earnings. That's profits the business has earned, but that it has retained or held in the business rather than paying it out to the stockholders in the form of dividends. Our retained earnings are made up from our revenues minus our expenses minus any dividends, or the money we bring in by selling stuff to people minus the cost of selling that stuff to people minus the dividends, or minus any amount that we decide to pay out to the shareholders. All right, so we're going to go through some accounting transactions here, and we're going to talk about how they impact each part of the accounting equation. You'll notice that this fundamental accounting equation looks a lot like the balance sheet, right? Assets, then liabilities, and equity. So the first event or transaction is on October 1st, cash of $10,000 is invested in the Sierra Corporation by investors in exchange for $10,000 worth of common stock. Okay, so we would expect that our cash would increase and our common stock would increase. This is what I mean by dual entry accounting. We have an entry on cash and an entry on common stock. The other thing is this equation has to always be in balance. So you see the equal sign there between assets and liabilities. we have to always have the same value, total value, on the asset side as we do on the liability and equity side. So there we have $10,000 on each side. Second event, they borrow $5,000 from Castle Bank, signing a 3-month, 12%, $5,000 note payable. So if they're borrowing $5,000, we'd expect our cash to increase and our liability, our notes payable, to increase. Again, are we in balance? Yes, $15,000 on the asset side, $15,000 on the liability and equity side. Number 3, on October 2nd, Sierra purchases equipment by paying $5,000 cash. Here we would expect our cash to go down, and we would expect our asset equipment to go up. Now this is interesting, right? Because there was no transaction, nothing happened on the liability and equity side. Instead, we had a net zero change on the asset side, where one asset went up, the other asset went down. So there ended up being no change, still $15,000 on the asset side and $15,000 on the liability side. In essence, what we did is we took one asset and converted it into another asset. We took cash and converted it into equipment. Event 4, Sierra receives $1,200 cash advance from R. Knox, a client. So if we received a cash advance of $1,200, we expect our cash to go up, and we expect what's a liability called unearned service revenue to go up. The reason this is a liability is because the customer has paid us in advance of us doing anything, providing any service to the customer. So we owe that service to the customer still, and that's why it's a liability. When we earn it, it will become a revenue. Number 5, on October 3rd, Sierra received $10,000 in cash from the Copa Company for guide services performed. All right, so now if we perform the services, that means we've earned a revenue, so we'd expect our cash to go up and our revenue to go up. Again, we could check this and make sure everything balances, and it does. We have $26,200 on both sides. Number 6, they paid its office rent for the month of October, $900 in cash. We would expect our cash to go down, minus $900. And our rent expense to go up. Now we're not showing all of our expenses, as individual line items, just expenses as a whole right now. So there it is. Cash goes down, and rent. Here they show rent as a minus $900. I think that's confusing because we're doing rent revenue minus expenses, and a minus $900 would be a plus. Anyway, you see what I'm saying. They're just trying to show you that it goes down on both sides. That's why they're doing it as a minus $900. On October 4th, Sierra paid $600 for a 1-year insurance policy that will expire next year on September 30th. So now we're prepaying some insurance. We haven't used the insurance yet, so it's not an expense. Instead, we're creating an asset called prepaid insurance. So our cash asset goes down, prepaid insurance asset goes up. Number 8, on October 5th, they purchased an estimated 3 months of supplies on account from Aero Supply for $2,500. So here we'll see our supplies account go up, and it's on account, meaning we didn't pay cash. So we're going to have a account payable for those assets. Really, when you purchase assets, you can either purchase them with cash, or you can purchase them with an account payable, a debt of some sort, a liability. On October 9th, Sierra hired 4 new employees to begin work on October 15th. So hiring new employees does not change anything on our financial notes. Now when we pay those employees, it will. So this is going to be a non-transaction. All right, on October 20th, they paid a $500 dividend. Cash goes down, dividends go down on the other side. All right, event 11 employees have worked 2 weeks, earning $4,000 in salaries, which were paid October 26th. So our cash goes down $4,000, and our expenses are $4,000. There's our transactions. You can see how they total up at the bottom there, $23,300 on both sides. And there you go. All right, so an account is a record of transactions. Each item we've just been discussing, cash is an account. Rent expense is an account. All of these ideas are accounts. Accounts are broken down into asset accounts, liability accounts, stockholder equity accounts, and then revenue and expense accounts. Accounts are illustrated in what's called a T account form, which shows a debit and a credit column, and we'll talk about how to use those. I want you to forget everything you've ever learned about the term debit and credit. Most of our experience with that term comes from our bank accounts. And when money goes into our bank account, they call it a credit, and it makes us happy. And when money comes out of our checking account or our bank account, it's called a debit, and that makes us sad. I want you to think that debit and credit have nothing to do with happy and sad, nothing to do with good or bad, nothing even to do with increasing or decreasing. Instead, they're directional terms. Debit means left, credit means right. If we were on a ship, we would say port means left, starboard means right. We wouldn't imbue either one of those with any sort of supernatural goodness or badness, simply that one is left, one is right. And that's all it means in accounting. Debit means left, credit means right. If you have to come up with some tricky way to remember that, do it. When I was first learning it, I remembered that DC for Washington, D.C., don't know why that stuck in my head, that D was on the left, C was on the right, and that made it stick in my brain. So debit means left, credit means right. I know, I just did it 100 times, but remember, debit, left, credit, right. Okay. So the debit and credit system. Remember I said we have a double or dual entry system where each transaction affects two, sometimes more accounts, but at least two. And recording is done by debiting one account and crediting another. Every transaction will have debits and credits, and the debits must equal the credits. That's the rules. All right. When we're balancing up a T account, if the debits are greater than the credits, then we say that account has a debit balance. So, for example, we're looking at this account right here, has $18,000 on the debit side and $3,000 on the credit side. We'll total the debit side and the credit side. Then we'll subtract the smaller side, leaving us with a balance. So this account has a debit balance of $15,000. Here we have a transaction with $10,000 on the debit side and $11,000 on the credit side. Again, we'll total up both sides, subtract the smaller side, and what we're left with is a $1,000 credit balance in this account. All right, so here's why it gets confusing. Asset accounts have a normal balance on the debit side. Asset accounts are increased with a debit entry and decreased with a credit entry, which means we would expect that assets would have a debit balance or a balance of greater than zero. That's called the normal balance of the account. See the helpful hint? The normal balance is the side which increases to the account, or where increases to the account are recorded. Asset accounts increase with a debit and decrease with a credit. Liability accounts are the opposite. They increase with a credit and decrease with a debit. The reason for this is that these things work together. Typically, when an asset increases, the only way to do that is to borrow money. That's one way we can make, say, our cash asset go up, by borrowing. So if we were to do an entry where cash went up because we borrowed, it would show an increase to the debit, or a debit to the cash account, which would be an increase, and a credit to the liability account, which would be an increase. So these things work together. Stockholders' equity accounts look the same as the liability account. They increase on the credit, decrease on the debit. Then further broken down, our common stock accounts increase with a credit and decrease with a debit. Retained earnings also increase with a credit, decrease with a debit. And our dividends do the opposite because they have the impact of reducing the amount of stockholders' equity. There's almost no way to have this all make sense in your brain until you've worked with it a lot. I've been working with it for years. That's why I'm so comfortable with it. It's confusing at first for almost everyone. So sometimes you just have to memorize it. The good news is it's pretty easy to memorize because assets are one way, increase with a debit, decrease with a credit. Liabilities and equity are the opposite, which makes sense since they're on the opposite sides of the equal side in the fundamental accounting equation. We would expect assets to behave in an opposite manner from the liabilities and the equity. But really you just have to kind of memorize them until you get accustomed to how it all works. Revenue accounts, decrease with a debit, increase with a credit. Expense accounts are the opposite, which makes sense since expense accounts are the opposite of what revenue is. So an expense account increases with a debit and decreases with a credit. Here's the relationship in our stockholder equity accounts. Remember, on our balance sheet in the stockholder equity section, we have common stock, that's the investment by the stockholders, and we have our retained earnings, which is our net income retained in the business. You can see that our income statement provides the information for our retained earnings statement. So our retained earnings is found by taking our retained earnings at the beginning of the period, adding in any net income, which comes off the income statement, and then subtracting any dividends, which is money that we're paying out to the owners, and that will give us our retained earnings, which plugs back into the balance sheet. Here's a summary of the debit credit rules. You might want to take a picture with your phone. Also in some of the other class materials, I will have a little summary sheet for you as well. I call it a cheat sheet, but no one likes the word cheat. So we'll call it a reference guide for the summary of debit and credit rules. If you're going to stay with accounting at all, you need to just memorize this at some point. It's kind of like learning your times tables. All right, they really want us to go through this summary one more time. Debit. So assets are increased on the debit side. Expenses are increased on the debit side. Liability, equity, and revenue are decreased on the debit side. And the opposite will be true with the credit. Assets are decreased by credits. Expenses are decreased by credits. And liability, equity, and revenue accounts are increased by credits. More summary. All right, so now let's talk about how we record transactions. So what we do is we go through a process where we analyze the transaction, we enter the transaction in what's called a journal, and then we transfer our journal information to our ledger accounts. When we're initially analyzing transactions, we use something called source documents. That's like if you ever have to go buy something for work, they want you to have a receipt, or for church, and then you take the receipt in and you turn it in, and they reimburse you from that receipt. That's a source document. All right, so the journal is where things are entered originally. Most places now, these are all computerized and electronic, so journal entries happen in an electronic thing, not in an electronic manner using a computer, and not in an old 4-column journal book like they used to. So transactions are entered in chronological order. Just as transactions happen, they record them in the journal. And then the process is broken into, or I guess this is just their contributions to the recording process, sorry. It just breaks it down so that it's easy to figure out what's happening for anybody who's looking at that journal entry you made. All right. So to enter transaction data into the journal, they're going to give us an illustration. This is using a few of the transactions that we already had looked at previously. So we're going to journalize these 3 transactions. All right, so Sierra issued common stock in exchange for $10,000 in cash. You can see up top what we did earlier, but just by kind of analyzing it, what it would do to cash and what it would do to common stock. So the journal entry will look like this. Cash, debit, common stock, credit. And sometimes they'll put a note. This one didn't have it, but the note might say, money received from stockholders. We don't always do notes, especially when it's obvious, like this transaction, but some transactions aren't as obvious when you're first looking at them, and so a note helps clarify for someone else who'd be looking at it. All right, borrowed $5,000 by signing a note. So we would have our cash account go up or be debited, and our notes payable go up or be credited. You'll notice they always do the debit entry first. That's the common or standard convention. Okay, debit first, followed by the credit. Finally, we have Sierra purchases equipment for $5,000. So let me walk you through the process just to make it sure you recognize what's happening here. So I have to ask myself, what accounts are being impacted? So purchasing equipment, my cash account is going to be affected, and my equipment account is going to be affected. And I have to ask myself, what kind of accounts are these? And the answer is they're asset accounts, both of them in this case. Then I have to ask myself, okay, what are the rules for asset accounts? They increase on the debit side and decrease on the credit side. Finally, I ask myself, okay, what's happening? And I make the transaction. So if I'm purchasing equipment, my equipment is increasing, and an increase for an asset is on the debit side. So that'll be my first entry. And then my other asset, cash, is decreasing. That'll be on the credit side. That's the process I go through in my brain each time I do a journal entry. Don't worry, as you get better at it, you get faster at it. Okay, once we've recorded things in our journal, we're ready to transfer them to a ledger. A ledger is an individual account for each, or an individual record for each account. Okay, so remember in the journal, things were recorded chronologically, but we kind of lumped all the accounts in because we were just doing it transaction by transaction. In the ledger, what we're doing is we're taking it account by account, and we're getting a subtotal of the amounts in the account. Remember the T accounts we looked at earlier that had debits on one side and credits on the other? That's usually how ledgers are presented. This is called a chart of accounts. It's a list of all the accounts that a company will use. Each company's chart of accounts will look slightly different, but they have a lot of the same elements, that there's assets, liabilities, equity, revenue, and expense accounts. Some companies have more than one type of revenue. Others only have one. Some have many more expenses, some have fewer, but it's the same concept always. All right, so here's how we post from our general journal to our general ledger. See, remember the journal was the chronological recording of transactions. Now the general ledger has a separate record for each type of account. You can see the general ledger for cash right there. So we're going to go ahead and record that our stock was issued and it debited the account by $10,000, and that creates a balance of $10,000 in the account. That's how we post from the journal to the ledger. Here's the recording process in full. I won't read it to you. It's in your book. You can also pause it and look at it here if you want to spend more time kind of letting it sink in. But you can see what's happening from the journal entry. Things are being posted to the accounts. You know what, why don't I walk us through these? It's a little long, but let's do it. So what they just want us to break it down. So this is back to those original 11 transactions they had us look at for the Sierra company. Let me walk you through them. You know, if you don't like it, you can fast forward through it or whatever, if it's too easy or whatever. But for some people, there might be value. So on October 1st, stockholders invest $10,000 in the company. So we asked, the basic analysis is to say our cash increased and our equity increased. Then we ask ourselves, okay, so cash is an asset account. It increases with a debit, and stockholders' equity is a equity account, or stockholders' equity account. It increases with a credit. Then we can make our journal entry that shows cash debited $10,000, common stock credited $10,000. Then we post the journal to the individual T accounts for cash with a debit of $10,000 and common stock with a credit of $10,000. So that's the process you walk through. Let's see, they borrow $5,000. So again, and that's on a notes payable. So we say, okay, I've got an asset account increasing here, cash, and I've got a liability account called note payable that's also increasing. Then I figure out how these accounts work. Asset accounts increase on the debit side, liability accounts increase on the credit side. Then I go ahead and do my journal entry. So I do a debit of cash, 5,000, a credit of notes payable of 5,000, and then I post that journal entry to the ledger, where the cash, you can see, increases by 5,000 or is debited, and you can see the previous transaction is already there in the cash account, and the notes payable increases or is credited by 5,000. In event 3, we go through the same process, cash and equipment. Cash is going down, equipment's going up. Cash is an asset, so is equipment. So the asset accounts, a debit increases an asset, so equipment will be debited. Credit decreases an asset, so cash will be credited. Then we do our journal entry. Then we post that over to the account. There you can see the cash, the $5,000 credit, appears on the right-hand or credit side of the cash ledger. All right, I'm going to walk through these a little bit quicker. Here we have a $1,200 cash advance from a customer. That's our cash going up, which will be a debit to cash. And our unearned revenue, which is a liability, also going up, which will be a credit to the unearned revenue account. There you can see in our journal entry, and you'll see a note because it's a little more confusing than some of the other transactions. It says received advance from RNOX for future service. And then we post it to the ledger. $1,200 on the debit side for cash, $1,200 on the credit side. Remember, there's always a debit, always a credit, and they always equal each other. In event 5, $10,000 cash for guide services. So they're going to go ahead and post. They have a cash account, which is an asset account, and a revenue account called service revenue. Cash will be debited or increase 10,000. Service revenue will be credited or increase 10,000, and then we'll post them to the ledger. In event 6, they paid $900 for cash, which means cash is going down, and rent expense is increasing. So we'll debit the rent expense account, $900, and credit the cash account, $900, and post them to the ledger. To the ledger. All right, event 7, they paid $600 for a 1-year insurance policy. Cash is going down, asset prepaid insurance is going up. So we'll have a debit to prepaid insurance, a credit to cash, and we'll post it in our ledger. Number 8, let's see, 3 months of supplies for $2,500. Supplies is an asset account. They're not paying cash for this one. They're borrowing money, so it's accounts payable. So we have our asset supplies going up or being debited $2,500. Our liability accounts payable going up or being credited $2,500, and then we post it to the journal. All right. Event 9, that was one where they hired employees. Remember, that one is not a transaction we record, so nothing there. Number 10, they paid $500 cash dividend to their stockholders. The dividend account, which is a type of account, is increasing by $500, and the cash account is decreasing by $500. So it'll be a debit to dividends, credit to cash. And finally, they pay employees' salaries, $4,000 in cash. Cash accounts decreasing, which will be a credit, and the salary and wage expense is increasing, which will be a debit. So you'll notice between these two transactions that dividends and expenses look a lot alike in the way they post, because they in essence do the same thing. They reduce the amount of cash on hand in the company usually, or if they can be paid in other ways, but typically that's what they do. The difference is that expenses reduce the net income, whereas dividends don't. They just directly reduce the retained earnings, and it'll make more sense as you do more with it. All right, so here's a summary of all the journaling we just did in the general journal, listed by date. This is what your journal would look like as you recorded transactions chronologically throughout the month. And then there's a summary of what our ledgers would look like. You can see the cash account, again, has all of those transactions posted. The debits are on the debit side, the credits on the credit side. And then at the bottom, there's a balance. So there's $15,200 in our cash account, for example. Again, we expect to see our asset accounts with balances on the debit side, and we expect to see our liability accounts and our stockholder equity accounts with balances on the credit side. That's the normal balance for these accounts. Dividends have a normal balance on the debit side, and expenses have a normal balance on the debit side. Revenues, normal balance on the credit side. All right, last thing. I know it's been a long one. The trial balance. So a trial balance is just a list of the balance of each account. And it's always listed in the same order in which they appear on the ledger. And if you've noticed, that means asset accounts first, then liability accounts, then stockholder equity accounts, then revenue accounts, then expense accounts. That's always how they do it. So here's the trial balance. Again, those numbers come directly, I'm going to go back a couple slides here, come directly from here. These are our general ledger balances in red. You see the 15.2 for cash, 2,500 for supplies, etc. Those are just carried over directly onto the trial balance. And then at the bottom, we add it up and make sure that the debits equal the credits. And that's how trial balance works. And that's the end of Chapter 3. It's a lot of information. Just gird up your loins, fresh courage take. You can do this. Again, let me know if you need help. And I would suggest getting an early start on the work for this chapter. Have a great week.